Hello and welcome students, welcome subscribers, and if you're new, welcome. My name is Denzel, and in this episode, in this video, we're going over borrowing. What does it mean? How does it work? How can it change my life? Right? Those are the main questions we want to ask whenever we're looking at something in terms of our personal finances. How does it work? How does it help me or change my life? And what does it mean, right? How does it work? The basics, really, the fundamentals, okay? So listen, when we're talking about borrowing, okay, you have to understand, first, money is a tool. I'm going to say this in every one of my episodes. I'm going to try to when I'm talking to my students. Look, money is a tool, okay? I don't want you to love it. I don't want you to hate it. I want you to use it because it's a tool. Got it? Now, in order to understand how or what borrowing is, you need to understand the parties involved, okay? So, when this occurs in money, you have a borrower, and a lender, okay? This person, we're going to call them person A, okay, is someone that does not have enough money to buy something, to buy a home, to buy a car, to make a large luxury purchase, to go on vacation, whatever it is. There's a hospital bill, buy groceries, living expenses, okay? There's many reasons why we borrow money, okay? Now, client A does not have money to buy a particular thing. So what would they do? What can they do? They can ask friends and family for money. What if they don't have money? Okay? Most of the time, they can look at major banks, corporations, credit unions, and such. And those are the lenders, who are people or businesses with money that are willing to give you a principal amount, okay, a set amount of money, whether it's $1,000, $10,000, $100,000, $1 million, $100 million, okay? Whatever that amount is the principal, okay? Now, when this lender gives the borrower money, this person, client A, person A, must pay back the lender the principal amount plus interest. Okay? Now, there's two ways interest gets calculated. Two major ways, okay? And that's simple and amortized, okay? Now, I won't dive too deep because this is a whole video in itself explaining the differences, the pros and cons between the two, but just understand that there are two different ways that a borrower can repay the lender the amount of money they were given, okay? So let's say, for example, this person was given $10,000, okay? The lender has 10, and they're going to give it to the borrower, and now the borrower is going to pay back the $10,000 over a period of time, whether that's a year, 5 years, 10 years, okay? Plus interest. And it may be at, who knows, 5%, 10%, 12%, 15% interest. Whatever that number is will get calculated either simple or amortized, okay? Simple interest, okay? I want you to remember, simple interest is simple, okay? It's calculated on a daily rate every 30 days, okay? Simple interest is calculated daily every 30 days. Okay? Amortized interest, I want you to remember in your head, amortized is always more than simple. Got it? Amortized is always more than simple. Okay? Amortized interest is if you had the same amount, so let's say 8% and 8%. Okay? For this individual, let's say they went amortized interest on the 10,000, okay? They would receive a set monthly payment for a set period of time. Okay? That's how amortized interest works. If it was, don't worry about the number. We're just, just an example of 8% amortized interest on 10,000. The monthly payment would be set for a period of time. What happens with amortized interest is the interest gets calculated on the whole entire amount borrowed, okay? Annually, okay, every year. It'll get calculated. And that's where you get, where I said, remember, amortized, always more than simple, because of that reason right there, okay? Now, with simple interest, at the same 8%, let's say that client A wanted to borrow money, right? The same amount, 10,000, but let's say they didn't want to borrow it all at once. They can use 2,000 today, 2,000 next month, 2,000 the next month, and 2,000 the next month. They can do that. It's more flexible. Okay? So simple interest is simple, always less than amortized, and it's flexible. Okay? And with this same scenario, right, when that person uses the first 2,000, they'll only pay interest on what was used, not the whole amount. Okay? So if I was to ask you, who pays more interest of, so you got client A, for example, let's say client A and client B, right? Client A borrows 10,000 at 8% simple interest. Client B borrows 10,000 at 8% interest amortized. Who would pay more money? Okay? It's clear. Amortized would pay more money, because when client B got the money lent to them, right? They got what's called a loan. It's a loan. Here you go. I expect you to pay me back 10,000 plus more. All right? What happened to this person is they actually received the whole 10,000 right away. And then the interest starts to calculate day one, right? As opposed to client A that went simple at the same interest rate would pay less because of how they borrowed the money. So to recap a little bit more, is money is a tool, right? Don't love it, don't hate it, just want you to use it. There's two parties when we're talking about borrowing. You have the person that needs money, and then you have the person that has the money right now to give you. And that person is called the lender, or the bank, or company, or organization, okay? When the lender gives money, they give you principal, okay? And it's the borrower's responsibility to pay the principal plus the interest back to the lender over a set period of time, okay? There's two ways that the borrower can pay back the 10,000. and that's either simple interest or amortized interest. Got it? Cool. Awesome. I'm glad you got it. If you have any questions, don't forget to ask me in class. I will help you out. Reach out to me, and we can talk further about borrowing and how important it is to understand how to borrow money, when to borrow money, right? How it can change your life, okay? Because once you understand at a very young age, 12, 13, 14 years old, when you understand not only how money works, right? How the wealthy use it, okay? When you see how mom and dad use the money, you can make a comparison, right? Maybe they're doing that wrong, or you know what, they're doing that right. Okay, cool. All right. What also helps in the borrowing process, right, is having a good credit score, okay? I'll have a video for that as well, separate, where I just go over credit score, right, and what that means. But that does give you an advantage. Just remember that. Credit score, a good credit score, gives me an advantage when I need to borrow money. A bad credit score gives me a disadvantage when I need to borrow money. Because what can happen is the lender may say no, or they may say yes, and at the same amount of money that you want, they may go ahead and say, okay, we'll charge you 15%, okay? And that can hurt an individual over time, all right? So, yeah, that's how it can drastically change your life, is not knowing whether or not you have a good credit score, whether or not you're, worthy to repay the loan, okay? And what also can hurt you is not understanding how you can pay back a loan, right? Because if you go with this amortized for the same amount as the other person, client A, that went simple, this person would pay more money and not even know that they could have paid less back to the lender, right? So that can drastically, change your life as well. How you live and how you spend money and how you budget and all those things. It all correlates, it all relates, all comes back to the household and understanding your personal finances.